Hey, let's take a look at this. Let's take a look at number 2, guys. You are concerned, a client is concerned with the impact of interest rate risk may have on his portfolio and seeks advice on what investments should be avoided. All right, so just stop the clock right there. Some of these questions, you have to break them down a little bit before you read through the whole thing, or you're welcome to read the whole question, but you gotta focus in on the wording that's really gonna turn the question upside down. Interest rate risk, okay? So what is that about? What is that all about? That means, remember, when interest rates go up, the prices of outstanding bonds, all shapes and sizes of bonds in the marketplace are going to be impacted. So if rates go up, prices go down. If rates go down, prices go up. That's just a fact of life. I didn't make that up on the spot right here. So they're asking for your advice on what investments they should avoid. So I want to stay away from something that's going to be particularly impacted by interest rate risk. And RR might tell his client to consider minimizing capital investments. Okay, get the wording down there. Tell his client to minimize capital investments in what product? So we're looking at the 4 choices, and I'm searching for the choice. If I understand what the question is asking, I'm looking for the item, I'm looking for the product that is going to be most grossly impacted, most significantly affected by the movement of interest rates. My options are a bond anticipation note, or a 25-year AAA zero coupon bond, or an exchange traded fund, or a Treasury Note. All right, they're on the table. They are on the table. I will ask, today's election day, right? Today's primary day in New York City for the New York City mayor. Let's hold a little primary right now, shall we? Let's do our own little primary right now. Go into your voting station, which is the question pane on your GoToWebinar platform, and submit your nomination for the best answer to this question. Thank you, Megan, Renee, appreciate that. John, thank you so much. Everybody has to vote today. That is your right. That is your privilege as a citizen. We all got to exercise our right to vote. Don't let election day come and go and leave you behind. Cindy, thank you very much. Okay, so we've got a couple of answers in here. So when I think about interest rate risk, what pops into my mind is, yeah, rates go up, prices go down. Okay, it says that someplace in the Bible, I think. Now, we do know that there are different characteristics of a bond that are going to influence, certainly, how much or how sensitive the price change will be when rates change. So you may remember from some of your lecture and or reading that the 2 things that we really focus most heavily on are the maturity of the security and also the coupon of the security. You guys remember this? Okay, so the 2 rules of thumb are, just as a quick reminder, longer maturity bonds, longer term bonds are going to be more interest rate sensitive than shorter maturity bonds, or shorter maturity loans, if you will, right? So when I look at these 4 choices in front of me, I know they're all going to have different maturities. I've got a bond anticipation note. Now that is a type of municipal product. Now it doesn't say it's a municipal bond, but I recognize the language because I've read this chapter 3 times. I recognize the language bond anticipation note, and that is, of course, a short-term obligation of a state or local government. But the key word that I just said was the word short-term. Most municipal notes will mature within a year. Some may go out as far as 3. Seldom will they be longer than 3. But the point is they're fairly short, right? Treasury note, choice D, that's also a note, but that's a horse of a different color. Treasury notes you recall from the US government structure, you've got bills, which are short, notes, which are midterm, bonds, which are long-term, right? A note at its original maturity would be as long as 10 years to D-Day. So I've got two things in A and D, which are not longer than 10 years by definition. I have an exchange-traded fund, which is not even a bond to begin with. It's an equity security. That's choice C. So the answer that I'm going to wiggle over to is answer choice B, which is going to be a 25-year, that's a long maturity, AAA, that's irrelevant, zero coupon bond. Remember, the other variable in determining how much interest rate sensitivity we see is not only maturity, but also the coupon of the bond, my friends. So one rule of thumb, again, that you want to kind of unpack into this conversation, forgetting about maturity, let's just leave that to the side of the road for a moment. If we analyze interest rate risk vis-a-vis coupon, one thing we know for sure, the lower the coupon, the more impactful on its price will be a change in interest rates. Low coupon bonds are more interest rate sensitive than higher coupon bonds. And we don't really need to understand or worry about the theory there. But one thing that's got to come across loud and clear is that at the end of the day, right, if you've got a Walmart full of bonds and you ask yourself which ones are going to be the most sensitive, you got to find the ones that have the lowest coupons, and you can't get any lower than zero, and the longest maturities. 25 is pretty darn long, and it's certainly the longest of all the options here. That is how I arrive at my answer choice of the 25-year zero. Guys, can you give me a quick note in the chat instead of asking you a question? Just confirm to me that what I'm discussing with you right now, what I'm describing, does make sense to you, that you are with me in spirit, in mind. Megan, thank you so much. Appreciate that. I want to be sure that, thank you, Molly. Thank you, Satya. It's not all just about, me in this case, just kind of blabbing out all this information. It's really about being sure it's landing for you in a good way, and that if it's not, this is one opportunity to kind of, literally raise your hand or share a question or a comment, or hey, I hear what you said, Howard, but like I'm not really sure why, X or Y is going along the way that it is. Okay, so that's the key point here. It's about collaboration, it's about partnership, it's about sharing ideas and what's going in here. Okay, that you're exactly right, Cindy. B is a discount bond for sure because it says it's a zero coupon bond, right? The mere use of the term zero coupon automatically tells us it's going to be trading at a discount to its par value, and over time, the bond's value will continue to appreciate, and eventually, through an act of God, it will be worth exactly its par value at maturity. All right,